Good afternoon, everybody. Welcome to the TraderMerlin Show for your Thursday edition. It is the 9th of February. Or actually, not even February. I'm going back in time. We'll call it the 9th of March. 3/9/23 to be precise. That's why I put numbers on the screen so I don't forget. Hope you're all doing well. And as Skilled Stockman says, oh, sounds like a great show. I think it is going to be a great show. Well, simply because there's so much to talk about. We are in the midst right now of a absolute meltdown in cryptocurrencies. The financial and banking sectors are taking a huge hit. And crazy enough, it's because of those two things being inextricably tied together. And that's going to be the topic of the day. And of course, I had some fun with the animations and AI today. I said, show me a financial building with a nuclear mushroom cloud above it. And that's what or mushroom cloud above it. And that's the picture you got there. Pretty good for AI generation. And this is kind of what's going on with the banking sector. So for those of you who are following along and in the mainstream media, you know that because of what happened with Silvergate Capital. Actually, let me take a step back and explain what the hell is going on. First off, you know I'm optimistic for digital assets and cryptocurrencies, which I believe because of FTX's situation, what's happened, we've taken like 5 years backwards in progress with regards to cryptocurrencies. I still believe very strongly in the future of digital assets, but right now I think things are being pushed back because of bad actors, shysters, shady people that deserve to go to prison. Once those people are out of the way and good, honest business people step up and develop the technology, I think you've got some really good potential for the market for digital assets going forward. Because of FTX and their blow up, what it did is kind of pulled back the curtains on how everything behind the scenes, not just with retail investors in crypto, but institutions in crypto, and how that's all tied together. So what we discovered was you have companies like Silvergate, which was a bank, FDIC registered, all the documentation that's needed to be a registered bank. But their primary customers were cryptocurrency and digital asset firms. So you find them in the middle of this mix between, let's say, Circle, who's the backer or the creator of the stablecoin USDC. They're also in the mix of Paxos, which is the Paxos stablecoin. They're also helping with Coinbase and Gemini and all these other exchanges. Really not from the retail perspective. Silvergate is not a retail bank, so don't worry about someone swiping their ATM card and saying, hey, I'm a Silvergate customer. No. This is institutional stuff. And really what, in a bigger scale, Silvergate Bank was facilitating the movement of money between all of these. Think of it like a central bank for digital asset firms. I guess that's the easy way for me to put it. You know, if you look at the way JP Morgan and Bank of America and Chase all interact, a large part of that has to do with the central bank being the intermediary between all those banks and how they're connecting. That's really what Silvergate was doing for a lot of these major crypto firms and wasn't doing anything nefarious. It wasn't a bad actor. It's not like it was a Ponzi scheme. But because of some of their exposure to companies like FTX and others, they were left holding some assets which depreciated in value, ended up selling those at a loss, and now all of a sudden, there's not a lot of money there. Now, if we look at the chart of Silvergate, let's just bring up SI here. I mean, it's funny because you look at this chart and it's like, well, this isn't that bad. Well, look at the bottom half of it. You know, today you're down another 42%. I mean, this thing finished at $2.84. And I'm just going, holy cow. I mean, this thing is on a fast track to zero. As they mentioned, they are voluntarily liquidating their assets. So Silvergate is basically done. They're out. And that's the first big shoe to drop. Now, because of this, what happened is regulators immediately, if this was a normal bank, regulators would have gone, okay, let's let this Feds handle it. This is the FOMC or the Federal Reserve's problem. Let's let them handle it. But because you have some, well, I don't want to say clowns, but I would argue that most of our politicians are clowns. You guys know I'm very critical of the politicians and people that run the country. I think they're doing a terrible job. However, you have clowns on both sides of the aisle who are using this as a political platform to boost their career and say, see, I told you that crypto was bad. The reality is what happened with Silvergate is not a bad thing for crypto. They were actually doing a good thing. It's they got caught up in all this mix that Sam Bankman-Fried, I hope he goes to prison for a long time, that he and his cronies caused. Now, if you look at Silvergate, Elizabeth Warren, just pounding the table. We have to come with regulations. Crypto's bad. I told you, crypto, crypto, crypto. So she's using it as a platform. So are other members. And again, it's not Democrat or Republican. They're both using this as a platform. And what they're demanding is much stronger rules with regards to what any bank does with crypto. So boom, you had Silvergate kind of imploding, melting down a little bit. And then all of a sudden, any bank that has exposure to crypto is all of a sudden coming under the microscope. And you're seeing regulators say, hey, we have to go after this firm. And what about that one? And what about that one? Today it was SVB, Silicon Valley Bank. Let's bring up SVB. We'll show you. It's SIVB is a ticker symbol. This is down 60% today and already down another $1.38 in the after-hour session. It was trading at $270 yesterday on the close. Right now trading at $104.50. And I'm pretty sure that you are going to see this one drop even lower. So, you know, the question is, who's going to be the next one to get pounded by fear, FUD, fear, uncertainty, and doubt, of regulators coming after their bank and saying, hey, we're going to shut you down. Keep in mind that all of the assets in Silvergate, right? A lot of people think, oh, this is like FTX. Oh, here we go again. They're going to implode and everyone's going to lose everything. They are FDIC insured. Those deposits, up to a certain amount, are protected. So I think that's pretty good. At least to know that the consumers are protected, and this was a fully regulated bank. They weren't doing anything, at least to my knowledge, shady. The question I have for all of us is, okay, fine. This obviously is a huge kick in the gut, right in the groin, right in the square center of the groin for crypto. Just real quickly, let me show you what's going on with crypto. Because of what happened with this Silicon Valley Bank, the crypto markets are just getting absolutely butchered right now. The best performer in crypto at this moment is only up 3.35%. However, if we flip it down to go from the worst, Voyager down 25%. You've got Dogecoin down 8%. It's getting a little bit better, but even the big juggernauts like Bitcoin, right here's Bitcoin down 6.33%. We were talking about this in the CIL this morning. I thought 20,000 is going to be our target. Kind of funny. The CIL was at Crypto Investor Live goes from 10 a.m. to 11 a.m. Pacific time, and we were looking at this chart right here. I think I may have even shown you guys this one, and I would say, look, if we close down below this yellow box here, you've got a pretty good sell-off coming, and $20,000 was the target. And just so I can gloat just because it was a good call, and I hope that some people took that one. Here's where class started, 10 o'clock. Here's where it ended, right at 11. So right in the middle of class, started falling apart, and it's been going ever since. Luckily, or fortunately, it's starting to bounce here at 20,000. But, you know, when you look at the big picture, take a step back, I actually expected it to stop slightly higher than where it did, and that's why I went with the whole number psychology of $20,000 on Bitcoin. So there we go. Yeah. You have the crystal ball, Lisa. I saw that. I wish I had a crystal ball that told me to go short that one. Well, if you saw it, you know, go short on it. Take a small little stab at it. So I guess my question to all of you is this. Obviously, the pain, and I have this sensational, almost clickbait type of graphic right here with the mushroom cloud and the bank sector blowing up. I'm looking at this personally, and I'm thinking, okay, over the next few days, there might be some incredible opportunities to either be buying some of these financial stocks or maybe even the ETF itself, which is XLF, or what I will probably be doing in most of my accounts is I am probably just going to start selling a bunch of puts deep out of the money, because right now the fear in the whole banking sector, I mean, it's literally Macaulay Culkin in Home Alone screaming because he put aftershave on his face like, oh, look, a lot of these firms aren't going to get hurt that bad. JP Morgan's exposure to crypto isn't that bad. Matter of fact, they just pulled back. JP Morgan had exposure to Coinbase and to Gemini, and they said, hey, we're not going to do business with Gemini anymore. So you're already starting to see some people in this business kind of back away. The worst recipient of this is going to be crypto, because what banks represent is the onboarding. It's how you and I get our fiat into crypto. If they're not going to work with crypto firms and exchanges, then you don't have money flowing in or out of the crypto space. More importantly, money flowing in. So I think that this is very bad for crypto. Very, very bad for crypto. That could continue to push this one down. However, I'm in the business of trying to figure out how to capitalize on these market moves. So let's go look at the banking sector. Now, one thing I would encourage you guys to do, especially when you see sensational headlines like I have created here, like this kind of clickbait, is you should do a couple things very, very simply. Number one, go and find out which in that banking sector is blowing up. Because this title that I gave here makes it sound like everything is dying. And that is not true. If I look over here, I'm going to go out to barchart.com, one of my favorite places to go. When you go to bar chart's homepage, so I'll bring this up for you guys here. And by the way, I realized that a lot of people really didn't like macroeconomic topics because not a lot of people read the article I wrote last week, or on Wednesday. I'll have to change up my title to find what topic do you guys think would be a great topic for an article for bar chart? Let me know, and I'll write an article on that one for barchart.com. Anyway, since we talked about financials getting hit, simple thing to do is go to bar chart, just type in XLF. Right, you can see right at the top, that's the S&P Spider for financials. I click on that, and now I get a little overview page for XLF and all the pertinent details that you might find important. What I'm going to do, and encourage you to do as well to help you learn this stuff, is just scroll down on the left-hand side of your screen. You see it says constituents right over here. I click on constituents, and now it shows me all of the holdings of XLF. Now you can click this download button right here. I have already done it. You can click the download button, and that brings up an Excel spreadsheet that looks like this. So you can now take this and you can import this into your trading platform and now watch those specific market segments and weed out what's strong and what's weak. No worry, Oliver. A lot of people didn't read the article. It's okay. I don't take personal offense. I'm still learning as a writer. So, and here's what's really interesting about this one. Notice the number one holding in XLF. I bet most people did not know that Berkshire Hathaway is the number one holding in the financial index. Well, hold on a second. Berkshire Hathaway is not just a financial company. You're telling me that Apple is a financial company? Yes, they have some Wells Fargo, and yes, they have Geico. But they've also got a whole bunch of See's candies. Ain't no financial. I mean, it costs you a lot of financial to buy some See's candy, but ain't no financial. So there's some weird stuff in a lot of these indexes that I think is, needs to be checked out. That said, 14.61% is Berkshire Hathaway. Really the biggest hitter here is JP Morgan, 10.6%. Now they were down about 5% today, so I thought this may be an attractive buy for me. Keep your eye on JP Morgan and Bank of America. These are two that have not gone full bore into crypto. They might be dabbling a little bit, but they are not going all in, right? Their business is primarily lending out, making money off interest on deposits, traditional banking, and maybe branching out a little bit, but the core business is not crypto. If you look at something like Silvergate, Silvergate's not even on here. Let's scroll down to the one we talked about just a minute ago, which got hammered, which is Silicon Valley Bank. Number 52 on my list. And by the way, there's about 68 different banks in this financial sector. So notice here that SVB, who's down 60% today, is only 0.41%. It's less than 0.5% of the index. So really everything down here is almost insignificant. It's really not that critical in moving the markets. So I always like to look and see who are the heavy hitters, because big news in these, Bank of America, JP Morgan, Wells Fargo, those are the big ones that are going to have a much bigger impact on that specific ETF. So what can we do? Well, if you're looking to capitalize on this fear and FUD, let's go and start off with XLF, right? I actually sold puts on XLF at $34.50, and man, I did not think we would get there. Those puts are expiring next Friday. I see that, who has the Talking Monkey says my XLF put leaps are on fire. Absolutely, man. I mean, you got a gift horse today, Talking Monkey. Absolutely. Huge day for you. You got to question yourself, though, how long is this going to go? Is this a knee-jerk reaction of panic? You notice that on XLF, you could make the argument that we're coming right into an area of demand right around that $33 mark and $33.50. So, and that's kind of what I'm thinking, is there might be a bounce coming. Now, judging by the size of this candle, and I'll add on volume here because one of my favorite things to look for a market turn is a huge move one direction or the other, coming into an area of demand or supply, and volume that's triple, quadruple, 5 times normal. And all in all, what do we have going on right now? I'm going to actually show a graphic I don't normally do. Here it is. It's time for the chart of the week. Yeah, that's right. Tim did the graphics for me on that one. But, I mean, look at this picture. This is lining up to be a phenomenal potential bounce. You have fear in the markets. People are crapping their pants because of what's going on in financials. It's coming into an area of demand, and you've got volume on the entire ETF is triple normal. So I am going to be watching this as potential bounces for tomorrow. Now, you know, it's a double-edged sword here. Yes, I do think you'll probably see a little bit of a bounce tomorrow, but that momentum and pain could continue to spread, and we see it break right through that. So I have to be very careful myself because I'm catching that falling knife. But you guys, you know, one of the criteria that I love to find is when people have panicked, right? When people finally just throw all caution in the wind and they freak out, that's usually reflected by extremely high volume. And lo and behold, we had that today. This is the highest spike of volume since June of 2020. Pretty significant volume spike there. So anyway, just throwing that out there as a little cautionary note, and you might be able to get some epic premium at $33 tomorrow as well if you're selling puts. Now, I will not, absolutely not be trying to buy Silvergate tomorrow, right? I think that's just stupid. I think that, you know, the pressure on this one, could it have a big bounce? Yes, it could, but I just think it's really, really, really high risk. However, there's other firms out there like JP Morgan, right? JP Morgan is one that it's hard to argue with JP Morgan and their success and their strength and their power and reach around the world. Notice where I got my cursor right now. It's a similar picture. I'll put a little a line across the bottom. I'm not going to do a zone, but we'll just do a line. Right at about 128.50. Now, we are $2 above that roughly right now. So I might be looking at this tomorrow as potentially selling some puts that are fairly close to the money, and I might even be able to get some premium for next Friday, depending on how the market sets up tomorrow. But this is one that I'm interested in, JP Morgan, potentially buying for the longer term. And I may even look at buying some call options on this. I don't normally go directional, but I think you'll see a bounce. I think that this is a little bit overdone with regards to the market sell-off here. JP Morgan just in the last 4 sessions is down a total of 9.7%. Pretty significant. Now, the other one on here is my least favorite bank of all time. I think what they did to people during the housing crisis that I was personally aware of and witnessed through family and friends. The Darth Vader of the financial world, Bank of America, just heartless, callous, cold, uncaring financial firm that is interested in their bottom line, not people losing their homes. I hate the company, but who cares? I'm not trading for the love of a company or the hate of it. I'm trading for the opportunity to hopefully make some money on it. And you look at Bank of America, the chart does not look anywhere as good as you saw with JP Morgan, right? JP Morgan had some nice uptrend going. Bank of America, for all intents and purposes, looks like it's just kind of stuck in this sideways chop. That said, what question, bro? What question do you get all hostile at me? If you want me to answer a question, you have to ask a question in the right way. The way to ask a question on this show is to type in question marks before you send in your question, so I know what's sent to me and not just chat in the room. So, bro, there you go. Okay. Let me keep going here. So Bank of America would be another one that I was looking at, and that was pretty much it. I'm looking at other companies that have gotten hammered that might not have really any exposure whatsoever. So like Charles Schwab. And here's Charles Schwab, right? Charles Schwab has had that beautiful uptrend from July, moving all the way up to $85 in January of this year, and of course been selling off decently right now. Again, this is a situation where you might be able to collect some nice premium based off the fear factor and kind of the premium pump because of everyone looking for protection on something like Charles Schwab. Anyway, I put in all 68 companies in here. Charles Schwab down 12.7% on the day. Might present a good opportunity for those who have a longer term view of some of these financials to look at some individual securities that may be oversold, kind of beaten up. You know, if you look at the high on Charles Schwab that goes back to January of this year to where we are now, Charles Schwab down 23%. Look, Schwab doesn't have exposure to crypto. They're not a crypto lending firm. So I think they just got caught up in this fear and panic that happened in this financial sector. Again, leave SIVB alone. You know, could this have a huge bounce? Absolutely. I mean, hell, since we've talked about SIVB, it's already dropped another $5, and it's continuing to drop. So the B of A chart looks like a massive head and shoulders. Let's go look at B of A. So this was a question that came through from Skill Stocksman, I believe, Yeah, kind of a funny trivia question there, Jimmy. Bank of America was actually originally the Bank of Italy. Ironically, we're not getting any business being. I guess I have to do it in Italian voice. Ma, no, we're not getting any business being the Bank of Italy. Let's change our name to the Bank of America. Hey, this is very good. And next thing you know, they were one of the biggest banks in the United States. So you could make that argument, okay? And I always like bringing up chart patterns because I think it really has to do. Did I have YouTube? What's reading? I don't know. Do what you're talking about? Could you argue that this is a big head and shoulders pattern? Sure, but it's sideways. It's sideways. A head and shoulders pattern when it's sideways doesn't really mean that much. I mean, if you're reading this as a head and shoulder pattern, the way that you would do that is you're taking your line. What I don't really like about it is it's not really a true head and shoulders, right? You notice that this dip right here, which came in October of 2022, if you're doing the right way, you're connecting lows. Well, that's not going to work where I put it there. This is not going to work because you're now cutting through the bottom of that neckline. So yeah, you could argue it is, but it's not that great of one, right? As far as a head and shoulders pattern, it looks not the best looking. Let's see. I thought I had some more questions. Skilled Stocksman. Since I'm on this one, I will tell you right now. He says, I didn't adjust the font, but this was copied straight from the YouTube channel. Again, if you have any questions, you can always send them in on the YouTube channel. Real quickly, let me fix the font here because I always like when things are clear and readable, and I have a particular font that I use on this show, and take me just a second to get this font all nice and cleaned up for you guys. There you go. A little bit cleaner. Skilled Stocksman says, how do you identify a definite head and shoulders, and how do you draw the neckline perfectly? What time frames are best for head and shoulder patterns to be seen? Personally, it's all about the daily time frame. I think it's got to be on the daily time frame. Of course, you can see them intraday. I mean, they can be on any time frame, really. But I'm ultimately looking for something on the longer term. I prefer them on a daily. Now, a true head and shoulders, how do you draw it? Oops. Oh, wow, that was a new one. Let's go back to that slide. No, that's not where dab nabbit. Now I'm just messing myself up. I tried to do some live graphics for you, Skilled Stocksman, and look what happens. 1 second, I'm trying to get my drawing page back. Okay, I think that this is it right here. Oh, where am I? Come on, Merlin. Damn live shows. There it is. There's my drawing page. Okay, so a true head and shoulders pattern obviously would look like something like this. You have price moving up, trending up, and then you have a little bit of a sell-off, markets rally up. And at this point right here, there's no head and shoulders pattern. This is an uptrend. It's irrefutable. You cannot argue with me on this. That is an uptrend. No arguments about it whatsoever. With the head and shoulders pattern, though, what you get is right here. Let me do two things. Number one, I'll try to draw a line. Like if I drew a trend line right there, okay, awesome. It's an uptrend, not a head and shoulders. But the distinction, what makes a head and shoulders work is all of a sudden price comes back down to a level like this. Now, a couple things have happened. Number one is this trend line right here is broken. So we get rid of that. Let me get my eraser on here, get rid of those. And now we're left with, okay, I've got a security now that's come back to its most recent lows. And sometimes these lines are angled. In a perfect world, Skilled Stocksman and others, in a perfect world, you want it to be perfectly horizontal. But it's usually not going to be perfectly answer. I don't understand your questions, my friend. You're saying you read and don't answer if HNS is their CDAO 1 hour broke down power. I need a real question, man. So a head and shoulders would do this. If it rallies out of it, okay, you're still thinking bullishness, but now it doesn't make a higher high. That is a true head and shoulders pattern. Now, typically what you're going to do with head and shoulders is say, all right, this part right here is the neckline. I'll draw it in for you, neckline. Okay, and that connects the two kind of, I guess, the base of your shoulders here. So you have your RS, your LS is your right shoulder, the H is the head here, and then RS is your right shoulder. Ideally, you want those shoulders to be somewhat close and similar, but the key, it's more important that that right shoulder does not break the high or the head here of the head and shoulders pattern. How do you measure it? You take from the high there, all the way down to your neckline, and that becomes your measuring object. You can simply take that and use that as a forecasting tool to say, all right, I think it's going to go back down to here. And that's typically a head and shoulders pattern. An inverse head and shoulder would look obviously the opposite, where you've got things drifting down, comes back up, and looks like that. You draw your neckline across the top, and you use your measuring object here to see how far this might break to the upside, and there you have your head and shoulders and your inverse head and shoulders pattern. So, Skilled Stocksman, I hope I answered that one for you. You can have these things angled, but typically, you know, they're never going to be perfectly horizontal. You might have slight angles like this, but to me, it's really about location, right? In the example I drew for you on the left-hand side, what I'm looking for is I'm looking for a strong trend. I'm looking for something that's been moving up and hopefully going to start to show a little bit of weakness. And that's really the only time we see the weakness on this left example is when that high, the head here, the time we don't know it's a head, but as a uptrend starts to break down and comes all the way back down towards the most recent lows. If it touches that most recent lows, you know there's weakness because it shouldn't be that weak if it's really strong. If it makes it all the way back down here, that means the sellers were strong and the buyers did not support it at a higher price. They're not confident in paying a higher price. That's the psychology behind it. Chase says, does the neckline always need to be straight horizontal? No, it does not. And honestly, Chase, you're not going to see it always straight horizontal. What's more important is that you have the two bases of the, I don't know what you want to call it, but these 2 points right here. I'll circle them. I'll circle right here. You want to connect that point and that point on your chart, right? If you connect those two, then you'll start to have a real clear picture of what that left shoulder looks like, the right shoulder, and yeah, it might be slightly angled, right? It's no problem in having these things angled, but the key is to have, you know, there's your, could you have something that looks like this? Oops, I'll go down a little bit further. Something looks like that. Sure, you know, that's no longer straight. It's angled, but still tells the same picture, right? The keys here are that it's come back down and shown weakness, and then it doesn't make a new high. That's your real weakness, is that second circle I just put, because it's not making new highs. It wasn't a big uptrend. If it was strong, it would make a new high. It didn't. Wait for the break, look for a short, and price to go down in that head and shoulders pattern. Like if a head reaches a weekly demand zone, well, a head wouldn't reach the demand zone, right? If you're talking about a regular head and shoulder, which is the one on the left, oh, actually, these are both head and shoulders now. A head and shoulders pattern, the head would reach a supply zone, right? So you'd be looking at, you know, levels over here that may impact, and that could be a supply zone. This could be a supply zone, right? Right? You might be looking at things like that. If it's inverse, then the head would maybe be reaching a demand zone and looking to bounce back up from there. Our nice little side offshoot lesson there. All right. Steve, what do you mean there's this dude I have YouTube? What's reading? Oh, I see. Got it. But I was thought you meant in the chat. I like that. August Texan says fear equals big corrective moves. Yep. You know, and there was a comment earlier about our VIX today, and let me scroll up here. And someone's asking about other financials. I'm really not looking through all those financials right now. I'm just kind of going through the basics. And here's your VIX. So, you know, you talk about huge move up in the VIX. Guys, it's still only at 20.6. Remember, there's an old mantra in the marketplace that says, when VIX is high, it's time to buy. When VIX is low, it's time to go. Meaning, if VIX is really low, it means that the markets have really soared. There's been complacency. People aren't even thinking about fear. That's probably the time to get out. When VIX is really high, that means that everybody is panicking, buying puts for protection. They're freaking out. Markets are probably crashing. So when VIX is high, time to buy. It means there's blood in the streets. Look to be a buyer. The cutoff historically for that was 20 for the low point and 40 for the high point. That's the historic textbook version of that. Well, let me put a line on 20 and 40 here so you guys can see what I'm talking about. We'll start with the 40 mark. Well, I'll just put it right here, and then I'll change the value by double-clicking. Let's do 20, okay? And let's add in 40, just so you guys can see the typical range that they used to use. I don't personally think it works anymore, but there is your VIX range. So remember, below 20, when VIX is low, time to go. That means sell your positions. When VIX is high, time to buy. That means people are panicking. Notice we really haven't had any panic since October of 2022. The fact that we just broke above 20 today really makes me feel like there's not much fear out there at all. People are still very complacent. Money's still pouring in the markets and not looking for a lot of, downside move from here. So, yeah, we had a huge move up of 18%. Understandable when you have the markets drop, 1.8% for the S&P today. But this really is still fairly low. It's really not that significant, even though it jumped to 22.6. It's nowhere near 40. Right? You look back here historically to some of these bigger spikes. In 2020 when the pandemic hit, we were at 85 on the VIX, and it was even worse back here in 2000. See if I can put a monthly on here or weekly and show you more. So I'm not putting too much emphasis. There you go. The financial crisis, we were almost at 100, and from that point on, I'd actually really never used VIX. I just stopped using it because here's the problem. If you guys listen to that mantra I just said, VIX is low, time to go, VIX is high, time to buy, well, this is a huge surge up. And above 40 was that cutoff historically where VIX is high, time to buy. If that's the case, can you imagine how bankrupt you would be? Just think if you bought right here when the VIX broke 40, and let's say you bought when it got to 50. You're like, man, markets are tanking. VIX is super high. It's time to buy because this stupid mantra is in my head. VIX is high, time to buy. If you bought here in October of 2008, notice this, it kept on going. You would probably have had your account blown up within a month or two based off of the VIX. So yeah, I don't really use that. If there's a way you want to look at fear in the marketplace, just look at the price chart. You don't really need VIX anymore. I'm trying to get back to current data. There we go. I kind of feel it's broken, and right now it's still significantly low based off historical numbers. So there you go. Ganesh, you were expecting marketing to correct by mid-year. Do you expect correction to happen sooner if the Fed raises 50%? Yeah, I think it puts more pressure. Again, my prognosis or my hypothesis for this year was Q1 bullish. I thought we'd see some bullish moves in Q1. Q2 kind of leveling out, slowing down. Q3 and 4 would be negative. And I still stand by it. I do think we are on track for that. I could be wrong. But if you look at the data, the way it's pointing out, and if you read that article, if you read the article I wrote for Bar Chart, I stack up the three main variables that Jerome Powell addressed, which is slowing growth, interest rates, and unemployment. Tomorrow's number, I got to say, I think that tomorrow's number for unemployment is actually more important than the CPI number that comes out on Wednesday. I know, shoot me now. Why would I say that? Because right now, all the focus is squarely on inflation. Everybody and their mother is thinking inflation. And honestly, it's not dropping as fast as they wanted, but it's dropping, right? We are seeing it decline. That's great. As long as it drifts down gradually, the Fed can relax and backpedal a little bit. If unemployment continues to stay as low as it is, which is 3.4% right now, the Fed can be more aggressive. So I think the eyes are on the unemployment data, because if that starts to surge, then there might be an issue for the Fed with regards to raising rates. I still think we're getting 50 basis points on the 22nd. But we haven't seen the proverbial straw that breaks the camel's back with regards to unemployment data. It hasn't shown up yet. And I think that's very interesting because you've had 4.5% worth of rate increases in 12 months. It takes 9 to 12 months for the rate increases to hit the economy and really be felt by businesses. If that's the case, I apologize for saying this, but the shit show, the storm, it's coming. It's coming. And, the unemployment piece is critical for the Fed. They want to make sure keep unemployment low. And I would argue that they don't have any business, or they shouldn't be keeping it at 3.4%. Unemployment number historically averages 5.7% going all the way back into the 1928, I believe, through 2022. The average was 5.7%. So we should bounce back up here a little bit on unemployment. And Elizabeth Warren's screaming and yelling, oh, that's 2 million people are going to be out of work and feeling pain. It's like, first off, not everybody is going to be working. That's just the nature of the beast. And having a historical unemployment rate of 5.7%, use that as our benchmark. We're at 3.4. Elizabeth Warren should be just doing nothing but giving thanks and praise to the Fed for getting unemployment to 3.4%. Anyway, I'll stop that. Dude, what a poor attendee. You're not saying anything, my friend. You kind of babble. Ask a question, a specific question. I'm more than happy to answer it, but apparently we don't get on structuring a question here. I am happy to answer it. All right. You think credit card debt could be a problem down the road? Are you kidding me? Absolutely, August. Oh, man. I do those financial sessions with my friends on Wednesday, and, one of the big things that I'm going after is credit cards. Your goal for the next few months should be to get your credit cards as clean and paid off as possible, because if you need them in emergency, credit cards are great, but you can't rely on that. I mean, inflation is now called 6.5%. Then you're going to add on a 29% credit card interest rate fee. Good luck ever getting out of that kind of debt. So I think when people start to struggle, if we see the interest rates, that 50 basis point increase gets us to 5.25% on the Fed funds rate, you're going to start to see people feel the pinch a little bit more. Employers feel the pinch a little bit more as well, and it'll start to drop. As Talking Monkey says, personal savings is waning. It was like the highest it's been in a long time during the pandemic, and that has been just depleted, right? As we came out of the pandemic, a lot of people saying, hey, I'm buying. Good, let's go. However, you shouldn't be doing that. You should be investing that money. You should be growing that money. And I think that credit card debt will be a much bigger problem down the road. Absolutely, a major issue, August, is going to be credit card debt. It should be user like a loan shark that's giving you a loan at 20% and you're 25%. That's criminal. But a credit card company can get you 29% and they don't get in trouble. I mean, there should be reform on that as well, but let's just forget about that. All right, Edwood, whatever you say, buddy. Let's see. I think I had. I got the definitive head and shoulders question. Was there another one? Last one here, and then I'll wrap things up. Jimmy O. I don't know if you just watched the YouTube stream or what, but it says, what would happen if Japan decided to back their currency with gold? I'm not going to answer that one right away. I want you guys to tell me. Let's say, for example, and right now I don't believe there's any governments that are using their currency and backing it by physical gold. But what do you think would happen if Japan said, we're going to back the yen by gold? We're going to put the yen on a gold standard. You guys type in the chat. What do you think would happen there with the yen's price chart, right? And I'll bring up the yen versus the USD so we can take a peek at that. But you guys should all have a pretty good idea of what would happen with that Japanese yen should they back their currency by gold. One of the biggest problems we have with fiat currencies is they're backed by nothing, right? Almost all of them are backed by the full faith, which I don't have much of, faith in the government that is issuing that currency. So if you're the euro, it's the European government. If it's the pound, it's the British pound. If it's the rupee, governments are just backing it. So what you would see is a lot of people would look at the yen and go, this is backed by something. I can now redeem this for gold. So what you're going to see if that did happen, and I'm not saying it would, I don't believe it's going to happen to Japan, but let's just hypothetically say, if Japan backed the yen by gold, you would see a huge demand for the yen, and the yen would gain tremendous purchasing power. That chart that you see here of the USD JPY would go the exact opposite direction. It would be going straight down because the dollar would be losing value as more and more people would be buying the yen because it's actually backed by physical gold. That's really what would happen out there. Yep, Ganesh, that yen would go up, and it would go up aggressively. I mean, when the Swiss bank, let's look at the Swiss, do I have the Swiss franc on here? I don't have, oh, I do. Here's the Swiss franc. I'm going to go back a while. This was long time ago, but you guys see right here, this gigantic move in 2015 on the Swiss franc. This may look odd by itself, but this is a weekly chart. This was 1 day candle where it fell from 102 all the way down to less than 84 cents. You're talking over 1,000 pips, almost 1,600 pips on this. So the problem here is the Swiss franc was pegged to gold, and they removed that peg, and you can see what happened. All of a sudden, nobody wanted it. It just plummeted. Now, over time, things will correct. You can see it recovered fairly quickly. It took about a year to get back up there, but the Japanese yen would have the exact opposite. If they peg to gold, or if a currency decides to peg to gold, the value of that currency is going to skyrocket because now your ability to manipulate the currency goes down significantly. You're saying we're much more of a true currency. So, yeah, that's what would happen if the Japanese yen decided to back their currency with gold. What would happen if you bought 2 months puts on SI and set trailing stop trading for 3 months? Well, if you're looking at Silvergate, if you bought puts, not quite sure on that one, Michael. They may actually prevent you from buying options on that. Like there's a certain point where options will stop trading, and under a certain value, that's the case. If you look at the price of Silvergate right now, $2.84. I don't know what the options are going to look like for that one. I haven't looked. I will not be trading the options on Silvergate, but let me get that to the recent price. They may not even have liquidity at all for those options right now. Could you buy puts and hope it goes down? Sure. You're probably going to pay a pretty hefty premium on that one because anybody that's selling that put is committing themselves to buy, and anybody who's in the industry knows that Silvergate most likely is going to stop trading and go to zero. What would happen to gold if the Japanese yen is back? That's a good question, peasant. What would happen to gold if the Japanese yen? I think it would drive the price of gold up, right? Because now you have a reserve currency in the world to be backed by gold, so they would have to buy gold, a large amount of gold, keep that in their reserves to back their currency with it. So now you have a huge demand buyer coming in to buy a lot more gold. So yeah, it would drive the price of gold up significantly. Let's see. Vinay, what are the chances non-farm payrolls is good and bring everything back up? I mean, look, there's always a chance, right? It's not like this is the end of the world going to happen here. So here we have, here's what's happening for tomorrow. You can see on there, the major stuff's going to happen an hour before the market's open. So all the fireworks are going to be there already when the market's open. So you have unemployment rate. That's the number I'm looking for. Everyone's looking at the non-farm employment change. That's going to be important. But if I had to give a priority, I would say the unemployment rate is more important because that is the big picture of where we are as an economy and what the Fed is looking at. Non-farm payrolls, they were wrong last time on this number as well. We had 517,000 the previous previous month. Now they're expecting 224. If we beat that non-farm payroll number, it could go either way, right? My gut would tell me that if we come out with more jobs than expected, then the people will think, oh, now the Fed can be more aggressive because we have a lot of jobs. They don't need to be concerned with unemployment, right? So a good news there for non-farm payrolls could actually be bad for the market. So I'm not hanging my hat on any specific direction or reaction to the data. I think it's too tough. It's a gamble out there with regards to which way you're going to play it off the announcement. Now, the good news is market's going to be open, and this news will be out 1 hour before that market even opens, so you don't have to really worry about that. But there certainly is the potential that you could see a positive market day tomorrow. I actually think it could become unexpected because let's say, for example, you see your unemployment numbers here, 3.4%, and let's say it jumps to 3.6%. If it does jump to 3.6%, the Fed's going to look at that and say, maybe we don't raise 50 basis points. Maybe we only go 25 because we're already starting to see the impact on unemployment, right? So it's good news might be bad news and bad news might be good news. I know it sounds vague and kind of wishy-washy, but that's the truth of the matter with this economic data. Here is the FOMC projections for the 22nd. It's dropped a bit. It was 79% yesterday, and now it's 63%. So you could see, keep your eye on this number, right? We'll look at this today. Remember, 63%, we're getting a 50 basis point increase. And 36%, we're going to get a 25 basis point increase. This could change dramatically tomorrow, right? And I'll definitely check this on the weekend edition show for tomorrow and see how that unemployment data impacts it. I believe that if the unemployment rate is higher than 3.4%, that you'll see this probability shift downward, and there'll be more of a chance of a 25 basis point increase. If it comes out at 3.4, 3.3, 3.2, or anything lower than 3.4, then I would argue that you'll probably see the probability of a 50 basis point increase move up even higher. Advut, so I'm going to just tell you to stop talking politics here. The bottom line is this, and I will remove people for talking politics and pointing fingers and getting hostile. The reason why the U.S. is in an inflationary situation, as is most likely your country as well, as is European Union, as is Canadians, as is Australia, is because central banks put in a bunch of money. To point the finger and say that the Americans are the problems, Americans are a-holes, it's their problem, that's BS and actually shows a sign of ignorance. Your government is just as corrupt and just as bad as the United States government. They are just as bad as the UK government. They're just as bad as the European Union government. Those politicians, including yours, are there to save their own asses. And they're going to do whatever they can to keep themselves in power and not necessarily help the people at the end of the day. So, this is not an American issue thing. We weren't the cause of the problem. There's many things we do cause the problems of, but it's your central banks in your respective countries that have caused these problems. And I think that's the main issue we need to deal with. But let's not get it all. Yeah. But you come in here and talk politics and get hostile. It's the wrong place for that, my friend. We're talking trading and hopefully keeping it civil. All right, tomorrow's Friday. So I have no guest. Apparently my voice is going out because I've been teaching all day and talking all day in various classes. So I will go rest my voice. I will go play some trivia this evening, have some fun, hopefully win that trivia contest and the coveted trophy where we earn no prize. That's crazy. I do trivia on Thursdays and there's no prize for it. Again, tomorrow is really no topic. So what I would encourage you guys to do is do me a favor, send in your comments, questions, feedback, even advut, if there's avadhut. If there's something specifically you want, write it clearly, write it concisely, and email me at TraderMerlin@gmail.com. And if I find it worthy, I will make a show out of the topic. As all these viewers know, I am very happy to cover just about any topic. I don't really like to go into politics because I think that shouldn't get into your trading decision. We're trading price action. I like to look at macroeconomics. I like to look at the technicals, the fundamentals, and make trades off of it. Who cares who's running the country, who's running the Fed, or any of that stuff? Let's just make trades off the data that's present to us and hopefully not get all emotional about it. So, thank you, Lisa. If you liked the show, hit the thumbs up. If you didn't, that's cool as well. You can hit the thumbs down, but don't be a coward. If you do hit the thumbs down, email me and tell me why you hit the thumbs down. I have a feeling I might get one or two today, but that's okay. Just email me and tell me why, because I always like to make the show better. That said, hope you guys have a fantastic remainder of your day. I will see you all mañana. Take care.